Hello, good morning, everyone. Thank you for joining us for today's webinar. We will be doing, this is our first town hall webinar for COVID-19. We're going to give everyone just a couple minutes here to get logged in, and we will start shortly. Okay, it looks like we have a couple more people join, so we're going to go ahead and get started. So again, if you just joined, thanks so much for joining us today. Today is our first COVID-19 town hall. We'll be talking about what we know now when it comes to legislative details and just give an overview of the legislative updates. And then we will be answering your questions. We'll start with the questions that were submitted to us first, and then we will the question tab right now is actually open, so feel free as we're going through this to post your questions there. So just some housekeeping items before we start. Everybody's been placed on mute, but again, you can feel free to post your questions at any time in the question panel. Everyone will receive a follow-up email with a link to the recorded webinar, any training documentation today. Stay updated, register for our upcoming webinars on our COVID-19 page, and the link is there, ctrhcm.com. When you go there, you will see a big COVID-19 resource center, and that's something that we've pretty much been updating every day. If you have any questions, you want to request training, you have any ideas for webinars, feel free to reach out, training@ctrhcm.com. So we have a couple people on the call today. This is Kara Stuyvesant from CTR. We also have Bridget Escobar, Margie Hayden, and Sherry Campbell. So we're excited. I'm excited to have some different panelists on the line today. And they're our COVID-19 task force. And definitely, Margie and Sherry are your iSolved experts. So we're excited that they could join us. So again, we're going to talk about some legislative updates. We're going to start with the new updates to the FFCRA updated Q&A. We're also going to cover the updates to the PPP loan. And then we'll talk about the retention tax credit update and the employee retention tax credit. So let's go ahead and get started. So April 1st, as some of you may know, the DOL released a temporary rule, the rule regarding the FFCRA. Since publication of the rule, the DOL just recently issued some corrections to the rule itself, an additional Q&A, and they updated their facts to add 5 additional Q&A guidance on area of concern to employers. And so when you get this presentation today, you'll see that this is hyperlinked and it will take you right to the DOL's page where they've updated this. So what the frequently asked questions had to do with one of the first things is the DOL provided guidance on the issues of joint employment. And we've seen a lot of questions on this, whether workers who provide services such as landscaping, cleaning, or in childcare in someone's home, are they covered by the FFCRA? So the DOL follows that and this is just frequently asked question number 90 on joint employment and the FFCRA. The DOL has pointed out that a worker employed by a staffing agency and a client company may actually have two opportunities to be eligible for FFCRA leave. So again, this was recently updated. Specifically, in fact, the question before that, which I wanted to cover on the last slide, let me go back. Specifically for this one, the DOL reminded potential employers that the definition of employment under the FFCRA is the broad definition from the Fair Labor Standards Act. So whether the worker is economically dependent upon the entity for the opportunity to work. So the DOL used an example of a domestic service worker who may be economically dependent on you as a nanny who cares for your children as a full-time job, follows your precise directions while working, has no other clients. So if a worker fits that definition, then you may be obligated to provide leave under the FFCRA. So going back to this one, again, the DOL points out that a worker employed by a staffing agency and a client company has two opportunities to be eligible. So the meaning behind this one, if one entity has over 500 employees, but the other entity doesn't, then the worker may be eligible for leave from that second entity, provided both entities or two entities are considered joint employers. The DOL also, put some wording in there just to remind companies that if they exercise control over the terms and conditions of work, then they'll be a joint employer and they would be obligated to provide that leave under the FFCRA. And they've also stated that the DOL considers whether the second entity has the right to hire, fire, supervises, controls work schedule, determines pay. It would likely be a joint employer with the staffing agency in making the determination of control. So moving on, and I see my screen is freezing a little bit. I'll wait for that to update. There we go. So the DOL next provided guidance on whether an employee who is able to telework would still be able to seek FFCRA benefits if their child's school is closed. In this question, the DOL tells employers that the employee's verbal or written statement that they are unable to work due to school closure is all employers can require, even if the employee has been successfully teleworking from home since the onset of the pandemic. So for this one, in other words, if the employee meets the requirements of the paid leave, leave cannot be denied simply because the employee didn't request it earlier. They have pointed out that employers can discipline employees for falsely asking for leave. And this is a tricky one, so they give an example on the site that even in the event the employee does not have children but seeks leave due to school closures, that you can discipline employees for doing so. Hopefully that doesn't arise and you don't have employees that are doing that. But, they did point out if you do, you can correct that.
Thank you, DOL, for stating the obvious.
Right.
I love when they give clarification on something that's pretty easy, right? They never give us clarification on the gray areas that all the employers face. Sorry, just
right.
had to get my 2 cents in there, Kara.
Yeah, no, I agree. So next question, and this was frequently asked question 92. The DOL clarified that if an employee is seeking paid sick leave under the FFCRA, that the employee's own identification of their symptoms and a date for a doctor's appointment or test is sufficient to support the need for leave. So there was a lot of question surrounding this. So this is actually one of the ones that I'm glad they clarified. Employers cannot require additional documentation to prove that the employee actually had an appointment or test, which was done intentionally for employees to take leave and stop the spread. They also, on this one, reminded employers that if the employee is seeking unpaid leave under the FMLA, those rules on documentation still apply. So again, tricky one. If the employee is seeking unpaid leave under the FMLA, rules on documentation still apply. And finally, in the home stretch here, the last one, the DOL states that leave under FFCRA is not available simply because school is closed for the summer or any other non-COVID-19 related reason. Employees are still entitled to leave if their child care provider or summer camp program are not available for a COVID-19 related reason, but that specifically the FFCRA leave is not available simply because, you know, your child care provider school is closed for the summer. And this is something, you know, we wanted to put in a reminder about how you can view your FFCRA credits in iSolved. So this is something that, you know, we've done webinars on, and we have documentation on the client landing page. We also have documentation on our website. But just as a reminder, you know, to all of you, if you are using the FFCRA earnings codes, and if you do need to use those and aren't currently using those, you can just reach out to your support rep to get those set up. But if you are using the FFCRA earnings codes, you can view those. In this screenshot, you can see the payroll summary preview, and you can see right on the payroll summary preview when you pull the report exactly what the credits are. So you can see in this example, you have your FMLA and sick pay, 2 tax adjustments. And then again, this is breaking it down a little bit further for you. You can see by earning code, not only just the FFCRA earning codes, but the sick and so 2 examples here. And then the other place that you can see the earnings codes, and this kind of breaks it down for you. So if you're wondering, you know, how, when you bring up your payroll summary, it will show you the total. But if you're wondering, you know, how that's calculated and the breakdown of it, you can actually go to your business credit screen, and you'll be able to see the breakdown in this screen.
And Kara, just one more thing that came out, kind of the business credit screen was the first place that we had the opportunity to look at the credits and see how they were calculated and where they were applied. And there's also a report, a standard report that can be run that will show you, you put in a date range and it will show you all of the credits and basically the same information on the screen, just in a report fashion.
Perfect.
Thanks,
Thank
Margie.
you, Margie. And I would like to say amen and hooray for this. I think this has been one of the best news pieces that we have seen. So we just wanted to remind everyone that the EEOC has decided that any EEO1 component data collection that occurs will not take place until 2021. So hooray, that's one less thing that we have to worry about and do while we're trying to keep up with everything else.
I just look back, Kara, and I think of how stressed all of our clients were about this deadline last year and how this seems so long ago and how the stress involved with this task is just pales in comparison to what we've been dealing with lately. You know, it's just funny to me, but boy, are we thankful that this has been extended.
Yeah, absolutely. Okay, Bridget, you want to take it?
Yeah. So as far as PPP loan updates, I can tell you that it's been a little frustrating, and I know that you all are frustrated as well, is just waiting for that guidance from the Department of Treasury and the SBA on calculating this loan forgiveness piece. It's a struggle, and we realize that some of you may be halfway into your 8-week period and you're still waiting for answers. Just so you know, I got a text from one of our banking partners, and he said in a text, are you guys getting slammed with a ton of questions on like what pay period should we include? Because we have people asking us, and you know, we're just kind of sick of it, and we wish that the SBA would give us some guidance. And I said, oh, you are preaching to the choir. So you know, we check every day, morning, noon, and night, looking for some updates from the SBA. There were some this week, and I wanted to cover those quickly. But really, we're looking for some more detail on that loan forgiveness piece so that we can make sure that we're 100% confident that the information that we're giving you and the reports that we're giving you are based soundly on legal principle given to us directly from the agencies that are going to be reviewing these loans and the loan forgiveness in the end. If it's up to the lenders and they don't want that, I mean, if they're going to be doing their own thing, it's going to be a little crazy. So we're still hopeful that we're going to get that guidance and that it would be based off of something that is definitely reasonable. And we're going to get into here in a minute what the AICPA has recommended. So as for the latest guidance this week, you know, they're still talking about the good faith certification of necessity, which, you know, it's a good thing that they've clarified this, because I can tell you that a lot of businesses have been very concerned as to whether it will be perceived that they really had a good faith necessity for this loan when they got it. So the latest clarification is great, and I'm sure many of you have seen these, and if you hadn't, I'm going to go over it quickly with a little additional clarification here. So loans under the 2 million mark, there's a new safe harbor that any borrower with a loan that together with its affiliate is less than 2 million will be deemed to have been made the good faith certification. So that will help those businesses rest a little easier from that perspective. Now, on the loans over 2 million, they extended the deadline yet again. So now you have until May 18th to reassess your necessity for the loan. And so there's been a lot of guidance on, you know, what you need to do from, you know, different law firms as well as the SBA to assess your necessity for this loan. So in general, the guidance requires businesses to evaluate their access to other sources of liquidity sufficient to support their organization. So I've looked at different, you know, some of the bigger law firms across the country and what they've been recommending. And so what they're saying is you should keep a quote unquote reliance file showing what FAQs, articles, internet searches, advice, and notes that you use to make your determination. Well, now that the SBA has pushed that deadline until May 18th, you should make sure that you're going back and reevaluating that need as of May 18th, updating all of your documentation to make sure that it's current. Now, there is a little bit of good news for the loans over the 2 million mark. FAQ 46 states that if the SBA determines that you did not meet the required certification of necessity, so they've got their auditors, they come in and say, hey, we don't think you really needed this loan from the beginning. They will ask for repayment of the outstanding loan balance. So whatever you didn't spend, you're going to have to repay. And they're saying that the borrower is not eligible for loan forgiveness. They said they will not pursue administrative enforcement or refer to other agencies like the DOL or the SEC. So that really is the key here, and that's why I have it in bold. So they're not going to seek civil or monetary penalties. So that, that's better. So you're just basically going to have to repay the loan. So I think that can make some businesses sleep at night a little better. And I don't know whether that'll change their decision and how they look at this. But what another law firm pointed out is that doesn't mean that the DOJ, the Department of Justice, or the SEC can't independently come after you. They have their own authority and roles, and they could seek independent enforcement. But, and this is just my opinion, which you can take with a grain of salt, of course. Typically they like to get the most bang for their buck and go for the things that make the headlines. So, we'll have to see how much enforcement and what industries they target and what types of businesses, if they even do. But it is good to know that the SBA, they're not going to be seeking administrative enforcement. So that's good. Kara, you can go ahead and move us along. So this was posted on May 3rd. We sent a notice out. It's worth mentioning again if you didn't know, but I'll cover it quickly because some of you probably already do. Your loan forgiveness will not be reduced if you laid off an employee. You offered to rehire that employee, but the employee declined the offer. And what you need to do is you make sure that you have the offer, you make the offer in writing. It must be for the same hours and wages, and then you have to document the rejection of the offer for the employee. So it's nice to see that they are starting to add some clarifications that at least make a little bit of sense. So let's see if they continue this trend now that we've seemed to have gotten over the certification of necessity piece. Now we can hopefully move on to the loan forgiveness calculations, and we'll get some more guidance on that. All right, next. So like I mentioned, the AICPA has made some recommendations regarding loan forgiveness. So just to back up here, the AICPA is the American Institute of CPAs. They have 44,000 CPAs under their umbrella, which they represent 3.5 million small businesses, 60 million employees. On the initial piece of this, for calculating payroll costs in getting the loan, they did make some important clarifications that were eventually adopted by the SBA. So we definitely see them as a leader and a driver. And we hope that their guidance will be accepted by the SBA. And I can tell you that some CPAs that we work with, they tend to lean on their guidance in areas where it's vague. They tend to try to interpret it in the way they think that the AICPA would interpret it. So I thought it was important to bring up some of their points here. So the first recommendation is they're recommending that the 8-week loan period aligns basically with the employer's pay period. And, this is a big one, and we all know this makes sense. It's extremely difficult to try to calculate this right smack in the middle of a pay period. It requires you then to calculate basically employees' wages by day, and it's going to require a lot of manual manipulation and manual calculations on the part of employers. So what they're saying is they want to begin the 8-week period either at the beginning of the payroll period during which the funding was received. Because remember, the 8 weeks start when your funding is received. So either that pay period or the next payroll period. So the example they gave is funding was received on April 10th. Employer is on a semi-monthly pay cycle. Employer could start the 8-week covered period on April 1st or April 16th. And I've already seen that a lot of CPAs are just pretty much taking this stance anyway. They're including, every payroll period after that loan disbursement date. And so, they're kind of already doing that anyway until we get some further guidance. All right, next one, Kara. The next one they're saying, and, this makes a whole heck of a lot of sense, but, this one might be a little bit of a push and we'll see what they say. But they are recommending that the 8-week period begin when operating restrictions are lifted for the business. So the 8-week period, 8-week period should start once the stay-at-home orders for essential businesses, those restrictions are lifted. The employer may use the pay period beginning during which, let me restate this. The employer may use the beginning of a pay period during which their operating restrictions are lifted. So if the operating restrictions are lifted in the middle of your pay period, you could use that pay period, or you could use the pay period after that. So let's see if that one gets adopted by the SBA. Next one. So this is a big one, and I know that a lot of our clients are struggling with the definition of full-time equivalent. So we know that it's clear for loan forgiveness, and they've clarified this specifically in one of the FAQs, that it is full-time equivalent. It's not number of employees, it's full-time equivalent. But how do they define a full-time equivalent? They've never said what that is. The AICPA is recommending that it is 30 hours, the same as under the Affordable Care Act. Now, this one, we're feeling that if they do provide clarification, that we feel pretty confident it would be the 30 hours, because under the CARES Act, like for example, the employee retention credit, they already use 30 hours as the definition of a full-time employee. They've clarified that. So it would make sense that they would carry that through to the PPP portion of the CARES Act. For salaried or other employees who may not have recorded hours, this is a little different. The AICPA is recommending using a wage-based proxy. And so I've pasted the example here that they provided. So for those employees that you don't track hours, the employees would be deemed an FTE if earnings are over $217.50. That's basically the federal minimum wage times 30 hours a week. Employees earning less than the $217.50 a week would be considered a prorated FTE. So an employee that earns $200 a week would count as 0.92 of an FTE. You can see the calculation there. All right, next one. The last here is the loan forgiveness reduction based on the reduction of wages. So here's the issue, and many of you have identified this and asked us questions about it. So the legislation says basically that there's a reduction in loan forgiveness for any employee whose compensation is decreased more than 25% from the 12-week quarter and the 8-week covered period. Well, if you just follow that basic math and you don't read anything into it, you compare the 12 weeks to the 8 weeks, the 8 weeks will have 33% less payroll because there's less weeks. That doesn't make sense at all. So what they're recommending, and I think this is really, a lot of CPAs have just said, we're gonna look at it this way because it's the only way that it makes sense, is to use an average payroll per employee per week. So we look at our 12-week period, we look at our 8-week period, we come up with an average. And that would be a much fairer comparison. The other issue, and this is another one that clients have raised, is there may be employees in quarter one who were unable or unwilling to return to work. And what they're saying, what they're recommending is the calculation should exclude employees who were not employed for the entire 8-week covered period. And there were a few questions surrounding this, and I think we'll get into those a little later where we have some specific examples and you could see how that would work. Okay. I want to touch very quickly on the employee retention tax credit updates. So if you are on this call and you have not taken a PPP loan, either you are not eligible, either you didn't take it, or you decided to return it. They did say in one of the FAQs that if you return the money, that you would now be eligible for the employee retention tax credit. So if that applies to you, I want to make you aware that the IRS posted 94 FAQs. Much better guidance here from the IRS than we're getting from the SBA and the Department of Treasury on exactly how this works. And, you know, we're not going to go into all these details, but I will tell you that they provide specific calculation scenarios, examples. They've done a very, very good job of giving us guidance on this. So I would encourage you to look at these. And if you are doing the employee retention tax credits with us now, we are helping you with those. But it's also important that you make yourself aware of the different regulations, because it may trigger when you decide to say, hey, I'm no longer eligible for this. You know, we're no longer under a restriction by the government that impacts our business because they're starting to lift these restrictions. So, you know, we need to draw a line in the sand here and say, okay, no, we're no longer eligible for these credits. All right, so next. So how do you qualify? So just giving the quick basics, the business must have been fully or partially suspended by government order due to COVID-19 during the calendar quarter. Initially, that was very vague. Now they have very specific definitions of what that means. Or your gross receipts are below 50% of the comparable quarter in 2019. You will continue to be eligible until the calendar quarter. Your gross receipts then reach above 80% of the comparable quarter in 2019. So if you want to qualify under this one, you're going to be needing to look at your financials and comparing it to the prior quarter and staying on top of it to see when your eligibility ends up going away. Because once that quarter arrives, you're no longer eligible. How much can you claim? You may claim up to 50% of qualified wages, including healthcare expenses paid in a calendar quarter. They have a cap per employee, so the maximum amount of qualified wages is $10,000. It's 50%, so that means the max credit for each employee is $5,000. Again, I keep saying this hasn't gotten a lot of attention. You don't see Trump standing up there or anyone for that matter on the news saying, oh, we've got this employee retention tax credit and it's wonderful and employers need to be taking advantage of it. All we hear is, and all we've heard of is the PPP and how wonderful it is. And, you know, there hasn't been a lot on this. I can tell you that we have some clients taking advantage of it that are getting significant tax credits. You got to make sure you qualify. I mean, I got a client that's got $80,000 of tax credits. So it's definitely worth looking into and reading those FAQs. If you are thinking about returning the PPP, you may be able to take advantage of this. All right, next. So when is a business fully or partially suspended due to a government order? I am pointing this out because it's important that they finally provided more clarification on this. And initially it just sounded like, okay, well, you know, we know the whole state of Pennsylvania is under pretty much a lockdown here. So it seems like practically every business could qualify when that shutdown was in place. And that was the way we read it initially, but now they added some more detail. So they added some restrictions on essential businesses. And here are a couple things they pointed out. If an essential business is allowed to remain open, it does not qualify even if the government order had an effect on its business. If an essential business may, but it says an essential business may qualify, and I'm paraphrasing here, I want you to actually read the FAQ. An essential business may qualify if the business's suppliers are unable to make deliveries of critical goods or materials during the government order. So maybe you could stay open, but if your suppliers couldn't give you the critical materials that you need for your business, you could still qualify. An essential business that is not required to close or suspend operations does not qualify for the sole reason that its customers are subject to a government order requiring them to stay at home. So that's an important one. There were a lot of businesses out there that were deemed essential, and now even though they had a decline in their business because their customers couldn't come and visit them, that doesn't necessarily mean that they qualify, but they could qualify under the reduction of gross receipts method. The last is if a business's physical location must close, but can still operate through telework comparable to prior to a government order, then it may not be eligible. So this would be a business that was deemed non-essential, but the nature of their business, they could have everybody completely telework, and they could pretty much run status quo. They may not qualify in that respect. All right, next. A couple other things. So one important thing to note is there is a very big distinction here between businesses that averaged over 100 full-time employees in 2019 versus the ones that averaged under 100 employees in 2019. The ones that average over 100 full-time employees in 2019 can only claim credits for wages paid to employees who were not working. Okay, big limitation here, because not a lot of employers are out there just paying employees who aren't working. They may have done it for a couple of weeks when they weren't sure what to do, when the government said, hey, we've got 15 days or whatever it was, 14, 15 days to reduce the spread, and they held on to the employees. But most of them said, okay, this is going to be a long drawn out thing. And they said, all right, well, we're going to have to make some decisions. We're going to have to lay off some employees. Unemployment benefits are great. We're going to have to make this decision. If you're not paying these employees because they're in their when they're not providing services, they wouldn't qualify. But now under the 100 FTE, it's a totally different story. You can claim credits for the employees that were working that you retained, but you do have to still meet the qualifications that we talked about before. You had to be impacted by this. So one thing that they clarified, and it was a little muddy, was how do we calculate the 100 full-time employees in 2019? And so what they said is that it's basically for employers with an average of over 100 employees, they're looking at it as for the ACA. So they're saying the line in the sand is it's 30 hours. So any employee that averages over 30 hours is considered full-time. Another thing they said is an employer with over 100 full-time employees in 2019 may claim the credits if the employee's work schedule is reduced, but the employer continues to pay the employee their full wage. And then the last thing that they said, and this was something that we weren't quite sure of, we thought maybe employers with over 100 employees, if they continued to pay the healthcare expense for those employees who were not working, which many of them have, they kept them on the insurance, but they may have laid them off. So they said for employers with an average of over 100 full-time employees in 2019, the employer may not claim qualified health expenses that it paid for employees who were furloughed, but the employer continued to pay health coverage. So they said, on that one. All right, next.
Okay, so that was a lot of information. So I know we're kind of short on time here, so we're going to get started on the questions that we had submitted. So I'm going to take the first question here. The first question is, some of our staff have significant case management responsibilities for our clients. A few of those staff have high-risk health issues. have been working from home and contacting their clients via video conferencing. This has been okay in the short term, but in-person client interaction is best for our clients. Is it possible and reasonable to change the staff job descriptions to require a certain percentage of on-site case management? If the staff person is unwilling or unable to meet clients in person, should it be concluded that perhaps our organization is no longer a good place for them to work due to risks associated with COVID-19? So this is a tricky one. You want to make sure that you're erring on the side of the employee, and you want to look at the employer piece of this too, and what it would be costing you. So the EEOC did release some updated guidance on this on May 7th. Here's what we understand from this guidance. So the first thing is to understand that you as an employer cannot assume. The employee or third party, so that their doctor, must let the employer know that the employee needs a change for a reason related to a medical condition. This can be in conversation or in writing. It doesn't specifically have to say reasonable accommodation. If the employee doesn't request it, the ADA does not mandate that. So the ADA doesn't mandate the employer to take action unless the employee's disability poses a direct threat to their health that cannot be eliminated or reduced by reasonable accommodation. They do recommend reassignment if an employer cannot make other accommodations. The CDC has also outlined guidance to help accommodate these high-risk employees. If you go to the CDC's website, it talks about who is at high risk and what to do to help accommodate that. They've also stated that this is, of course, all under the premise that the accommodation would not cause the employer undue financial hardship. Well, and, in light of what's going on, an accommodation prior to the pandemic may not have posed undue hardship to you and your organization, but now, in light of what's going on, it does. So, I tend to think of a child care facility in this instance, right? Child care workers need to be present. They need to be on site to take care of children. So, working remotely wouldn't be an option for, a daycare, and those employees are needed on site. And now, not to make this any more trickier, but I did just see where the state of Washington issued a proclamation giving high-risk workers the right to protect themselves without jeopardizing their employment status or loss of income. And, some other states may follow that or have already done so. So it's important that you keep up with the latest federal, state, and local jurisdiction because as we all know, this is ever changing by the minute. And just, one thing to add is, in cases like these, just be proactive, be prepared before you have a discussion with your employee on what's involved. Contact your legal counsel to be sure you're doing the right thing and being compliant. Sometimes things can be solved with a discussion, but be prepared, do your research to answer those hard questions beforehand. So next question that we had is a FTE following the 30-hour-a-week rule?
Kara, yeah, I can take this one. So when in this question, I'm just going to make the assumption that when you say FTE, you're referring to under the PPP and the CARES Act. So the CARES Act, like I said, doesn't define what an FTE is for the PPP portion. There are other areas of the legislation, like the Employee Retention Tax Credit, that does define an FTE using the 30-hour per week rule. And we also know the AICPA is recommending that. So I think that you could be very reasonable, barring any further guidance, in using 30 hours for your calculations at this point. And that's what I'm seeing a lot of the CPAs and other companies doing. Now, we are releasing a report today. And we will give you more information on this next week. It's just released by the iSolve developers, and we're going to do some testing and provide some documentation for you. It's an FTE report. It actually allows you to define what you're going to consider an FTE. But you can just plug that 30 hours in there, and it will give you your calculation. Next question. Go ahead, Kara.
Okay, so how and when are the FTEs being measured as it relates to the PPP loan? So I believe we have some screenshots for this one. Let me pull that up and share my screen.
Are you sharing your screen, Kara? I might be not.
I just
did. There we go.
Are you able to see it now? Okay.
Yes, I can. Okay. Can you make it a little bigger?
Sure.
So we can see it. Scroll down, actually. Scroll, yeah, a little bigger, bigger, bigger. Okay. So basically, the CARES Act. This is a two-part question to start off. How and when are the FTEs being measured? So the CARES Act was really specific on the when should the FTEs be measured. And if you look at the screen, this is actually a snippet from the loan forgiveness calculator tool that we provided to our clients. It's on our website. If you would like a copy of that and you don't know where it is, you can email training@CTRHCM and we can get you something. But this really does tell you the when part. It gives you all the different periods that you need to measure. And so what you can see here is you've got your 8-week covered loan period. That's one period, and that starts after your loan disbursement. You've got your first period is your average full-time equivalents for February 15th through June 30th, 2019. So that's one period. The next period is January 1st, 2020 through February 29th, 2020. That's your next period. If you're a seasonal employer, you're going to have to go with what your result is on the February 15th through the June 30th. You're going to go with that number. So of the two, the February calculation through June 30th and the January through February 29th, you're going to pick your lowest number. So you get to pick the one that benefits you the most. And then the next period that you have to measure is the number of full-time equivalents that you lost between February 15th and April 26th. The reason you do that is because the legislation says the ones that you lost during that period. So I think the assumption here is that, some of these employees were laid off due to COVID-19. If you bring them back by June 30th, then they do not count toward your loan, your reduction on the loan forgiveness. So that's the when. Now, if we scroll down a little bit on the screen here, for the how, the only thing the CARES Act says is they say that you calculate the average number of full-time equivalent employees for each pay period falling within a month. Again, no definition on what FTE is, but we're going to assume it's the 30 hours. So there's a couple ways to skin the cat here. You could go in and you could say, in the first example, and I'm using a weekly pay period here, Sunday through Saturday. So we're using the one period, January 1st through February 29th, 2020. So for that period, if I say my first pay period is January 5th, that's that first full pay period, I can start there on January 5th, and then I get my total hours worked, but you got to cap it at 30 hours per person. So like for someone that worked 40 hours, we're not going to count those additional 10 hours that they worked that week. We just limit them to 30. We don't want to overinflate them. So we calculate every single week, and then the next column gives you your dividing it by 30, you're getting the FTEs, and then you're getting your average by month, And so in this scenario, we're getting 40.2. If you scroll down a little bit, Kara, this is the other way you could skin the cat. If you know who your full-time employees are, right? So I know that I have in week 1, I had 10 full-time employees. You count them as a whole, right? So forget whether they work for, as long as they're over 30 hours, if you're using that as your threshold, they count as one person. So if you see here, I've got a full-time employees column. I had 10 the first week, 10 the next week. It drops down a little bit. You can see a little later and then gets back up to 10. So I count those employees. I remove them from the hours calculation. Then I take everyone else who doesn't normally work over 30 hours. And I put their hours in the bucket on the left here, and then I calculate my FTEs. So I divide that, and then I get my FTEs per week, and then I do my average. And you basically end up with the same result. So our FTE report that we're releasing today is going to be able to calculate these numbers for you. And like I said, there's a couple different ways you can do it. Hopefully we'll get a little more clarification, but that's what I've seen as recommendations out there from other CPAs as well. All right. Next question.
So when is my PPP FTE calculated? My 8-week period ends June 10th. Is my FTE calculation determined on June 10th or June 30th?
So there's a couple different periods at play here, and it's important that you're not getting them confused. So June 10th is the end of your 8-week covered loan period. So for that 8-week period, we believe that since the CARES Act is referring to pay periods within the month, that you would count each pay period that fell within the 8-week period when determining your FTE count. But remember, the CARES Act also does reference June 30th, so it's good that you're recognizing that date because it is another crucial date. And like I said before, it basically states that if the employer reduced its FTEs between February 15th and April 26th, and it brings them back by June 30th, then your loan forgiveness will not be penalized by that amount. So there's really two different calculations here in this question.
Okay. Next one. This is again on PPP loan forgiveness. What if employees had first quarter earnings but left employment before March 31st? They are included in the calc, but do we still have to pay them if no longer employed?
So, on the second part of this, you do not have to pay these people, especially if they're no longer employed. I mean, we got to remember here at the end of the day, we're all employers and, this isn't a charity. We're not just handing out money for people doing nothing. I don't think that's the intent of the legislation. But what's really not clear, I guess, in this question is whether the employees left of their own free will or whether the employees were furloughed or laid off, what was the scenario here? So let's just assume that if the employees were furloughed or laid off, you could try to bring them back. If they accepted and began working by June 30th, then you would not be penalized for the headcount reduction because you brought them back before June 30th. If you ask them to return and they refuse, as long as the request is in writing and for the same pay rate and hours, and you document the refusal by the employee, the SBA has clarified that you would not be penalized for the loan forgiveness. So, another scenario that we're hearing is that these employees may have voluntarily left, had nothing to do with COVID-19. So say you had an employee that was on maternity leave and they called you up and they said before March 30th, hey, I decided that I don't want to come back. This has nothing to do with COVID-19. And obviously, you're not going to be able to bring them back. You're not even going to try. It would be ridiculous, and it wouldn't be a good faith offer because they're not going to come back. So that's where it's tough, and nothing really has been clarified in that scenario, and it's definitely a common scenario. It does appear, if you're looking at the raw numbers, that on a headcount basis, you would be penalized because they're no longer employed. So, I mean, what does that mean for you? I guess less of the loan would be forgiven. You can choose to pay back the money. You can keep it as a nice low interest loan. But I think what we're really hoping for is a little more guidance in those scenarios.
Okay, next question. Employee has first quarter earnings, but went on disability April 1st. Common sense says not required to pay them, but what does loan forgiveness allow for?
Yes, I agree that common sense says that you're not required to pay them. You know, and I'd like to reach out, and Kara, if you can let me know who asked this question, because I think I'd want to get a little more clarification on the statement, what does loan forgiveness allow for? You know, following the logic here, and I don't know whether you're looking at this from a wage reduction standpoint and how you would be impacted. I mean, the employer would supposedly show a wage reduction for this employee of over 25% because the employee is now on disability, but the wage reduction had nothing to do with COVID-19. So yet the employer would be impacted on the forgiveness aspect conceivably because the employee is not being paid what they were for the first quarter. There really isn't guidance here, but the AICPA is recommending that employees who are not working during that 8-week period would not count. So, I mean, if that comes through, I think that would help clarify this issue. But again, I'd like to reach out to this person just to make sure that I'm understanding the question correctly as far as, you know, I think maybe you're asking, could we get loan forgiveness? I don't know if you're asking if we paid that, I mean, if we wanted to pay that person or not. So I guess I'll reach out and get more clarification.
Okay, and before we take the next question, we are approaching noon here, and so if you do have to jump off, if you have a meeting conflict or whatever, I just wanted to let everyone know before we take this next question that we will send out any question and answer that we did not get to today. So if we don't get to your question, we will still reach out and get those answered. So next question, what if, let's see, where are we? Did that. What if an employee leaves during the 8-week period? Is the employer required to pay them their 75% of their first quarter earnings?
So again, this is kind of similar. So we haven't received guidance regarding for the wage reduction rule for this specific scenario. We obviously don't think that you're required to pay them for not working, but the AICPA is recommending that, you know, the wage reduction rule only apply to employees who were active throughout that entire 8-week covered period. So that would really take care of that scenario if this does go through. Next one.
How can we make sure a full-time equivalent employee gets counted in the CTR system? If we are paying additional hours that were not punched in, and that's in quotations, will they count?
So the iSolve system can't report on data that's not there. So that's just a basic premise for anything. So our reports aren't going to calculate the hours if the employees never punched in the hours. Now, just because they didn't punch them in doesn't mean that you can't get them in the system. You can put the hours in different areas of our system. So before you process your payroll, if you need to add additional hours in iSolve on the time entry grid, you can add the hours in. If you have a salaried employee who doesn't normally punch in, there's an area called normal hours. It's on the refresh my memory, somebody here, Margie, Sherry, it's the salary screen, I think, is where that is.
It's on the salary screen and employee management, maintenance.
That's very useful. Not a lot of clients really kind of understood what that was for, but the purpose of that normal hours field is for employees that don't regularly punch in. you can put what their normal hours, their work schedule is per week, and it's just going to plunk those hours in every pay period so that our reports can use those to calculate FTEs. Now, if you're in a scenario where it's after the fact, you run a couple pay periods, you're already halfway into your loan period, and you're like, darn it, we're running these reports and there's hours missing here. What do we do? So I'm going to go out on a limb here, but Margie, you can correct me if I'm misstating something, but I believe we can go back and import these hours, correct, Margie, or do some kind of adjustment so we can get them in and on your reports?
Sure. Let me just like point out two good options to address that scenario. Yes, definitely. So we can create a memo calc to basically house those hours, and then once those hours are defined in the memo, for the reporting purposes that we're talking about, and specifically like the PPP report and then the new FTE report that's just been rolled out today, it has the capability for us to configure a custom accumulator for those hours paid hours, and basically define that accumulator to include the memo that you might have just populated with those additional hours that weren't recorded anyplace else. So that way, that's the way it would get into a place where it could be a part of the FTE reporting and the calculations and be more accurate for you.
Thanks, Margie. Okay, one more here. And hey, we're willing, I know it's after the fact, but it's Friday and I don't have another meeting yet, so we're happy to stay on and keep chugging along here.
Next question, I have accrued 401k safe harbor contributions that I owe my employees from January 1st, 2020 to today. Can I make my safe harbor make contribution to my employees' accounts from the first of the year through the end of my 8-week period and have that contribution count 100% toward the forgivable portion of benefits of the PPP loan? Or can I only count the portion of the match that is attributed to the liability I accrued during the 8-week period starting when I received the PPP funds? Whew. Okay.
Yeah. So that one is, and looking at this was one that was submitted ahead of time. And I took a look at this, and I also ran this by our CPA, one of our CPA partners. And we would say that since there's no specific guidance on this issue, but there is this language that we have to deal with, right, in the CARES Act, where it says that you're including costs that are incurred and paid. That's the language of the Act. We believe the more conservative approach would be to only attribute the liability that was accrued during the 8-week period starting when you received the PPP funds. Again, hopefully we'll get a little more guidance here.
Perfect.
Okay.
So here's one of the questions that came in, and I can take this, and Bridget, if you want to add anything to this. Just wanted to double check loans received from the PPP under $2 million will not have to be paid back due to good faith. That unfortunately is not the case. So, though borrowers under the 2 million mark may be in the clear as far as whether they can certify a need for the loan, you can still face scrutiny when it comes to forgiveness of the loan, depending on the guidance that comes out.
But definitely, and maybe this is kind of the driver behind this question is, if you were wrestling with that notion as to whether you truly had the necessity for the loan and it was a very gray area for you, I think this is giving these employers a lot more leeway from that perspective. I mean, they're basically saying that you de facto need the money because you're under that $2 million mark. And they basically said that they don't have the resources to do the audit. They said and if you can read the FAQ, they said that they'd rather basically get more bang for their buck and focus on the loans with the higher amount.
Yeah, and that's where the compliance effort may yield higher returns, right?
Exactly. It'll yield higher returns, but I talked to some clients that flat out told me, they said, look, we've had our best quarter ever. Like, we literally do not need this money. I mean, I think that if you feel that way, and you can all, people have different opinions, right, on that, but some have returned it even despite this, because they said, look, we really don't need it.
Next question. We received guidance that the 8-week period began when we received the funds from our bank. As we just had the restrictions lifted today, the time period would be very different. Do we know when the SBA will address the beginning of the 8-week period?
That's the question of
the
day, the hour, the last
every
month.
Day.
Yeah, every day. We don't. I mean, I talked, like I said, we talked to one of our banking partners, and they feel confident that guidance is coming. Now, they didn't tell me that they didn't get anything in writing from the SBA, or they don't have any special ins, but they felt pretty confident that it was coming, because they really feel like they don't have any guidance for their part of this. When they're requesting all of the documentation, what should they be asking for? So the answer is we don't know, unfortunately.
Yeah, and we're just as frustrated as you are on this.
One thing I wanted to chime in on, and I was actually talking to one of our CPA partners, and they said they've seen a definite shift in the frame of mind of some of their clients. And when initially the fear was, okay, I have all this money, and what if I don't get all the loan forgiveness? And it's like this anxiety of the need to spend the money. And a lot of the clients are like, okay, well, I don't know if I'm as nervous anymore about spending all this money. It is what it is. If we don't get the full amount forgiven, we can still pay it back. So there's definitely kind of a shift in mindset at this point. It's for a lot of businesses.
For PPP loans, are you saying that CPAs are saying that if your business has 2 pay periods per month, you could use the 4 pay periods that would cover 61 days in the months of May and June, rather than 56 days in an 8-week pay period? Did you catch all that?
I didn't catch all that, so I think I might rather take that one. I can call the person directly and address it with them.
Yeah, that one's a little bit loaded, so David, we'll follow up with you on that one. Okay, those were all of the questions that we received. So thanks Bridget, Margie, and Sherry for doing this and being a panelist, and thanks to everyone for joining our town hall. This was definitely our first one, and we ran a little bit long, but hopefully we can do this again, and we'll get the presentation and the question and answers out to you. And if we need to follow up with you one-on-one, we will do so. Just real quick, we do have an upcoming webinar next week on Wednesday on reporting. We'll cover reporting, and we'll talk about the specific COVID-19 reports as well. And you can register on our website, cprhcm.com.
Oh, I want to chime in, guys.
Yes.
Sorry, Kara. I do want to chime in on one important thing. The developers, they did release a loan forgiveness report, which is going to be great. I mean, again, we don't have all the details, so it's going to be largely based off of what we know, the AICPA recommendations, and it'll at least give you a way to run your information directly out of iSolve. The last loan forgiveness webinar we did, we kind of cobbled together some reports, and then you had to plug it into the forgiveness calculator. This is going to give you a little better functionality to just kind of spit out the information and review it. So we're really excited about that, and we'll be covering that on that reporting webinar too.
Oh, great. Yeah, good call. And so this was the communication that we have told you that, you know, it was delayed. We posted that on the client landing page, so we were very excited to see that did come out as announced today. So thanks, Bridget.
Yep.
All right. Thanks, everyone. Stay safe, stay well, and take care. Have a good weekend.
Bye. Thank you.
Bye. Thanks.